Okay, everyone, once again, welcome. My name is Jason. I'm from Syfe's investment and advisory team. All right, I'll be moderating today's session. As we wait for a few more others to stream into the room, let me just go through very briefly about today. Today is a very exciting topic. Fixed income is actually on the top of everybody's mind, right? And we have invited representatives from PIMCO to actually join us today. Right, so it won't be just me or Ritesh or the usual crowd, but rather we will have two very well-qualified professionals from PIMCO itself. Just a quick recap, what we're going to be going through today. We'll be going through a brief outlook of the market, right, as well as the fixed income. What's the outlook like? Ritesh will actually lead us through some aspects of the income plus portfolio, right, and then we'll end it off with a quick sharing by Alice, right, from PIMCO as well, with regards to fixed income and why now. Right, so before I hand over the time to Jingjing, all right, the poll questions are still up. All right, do fill up the poll questions. All right, we'll go through it briefly in a couple of minutes. Okay, and what I'll do in the next couple of minutes, as we wait for the poll results to come in, is I'll just give a brief introduction about Syfe, right, and who we actually stand for. So before I go on to that, let me first introduce our two speakers from PIMCO. Right, first up, Miss Alice Low, Senior Vice President and Head of Singapore Retail from PIMCO. Right, she has 16 years of experience in the financial services industry. So perhaps, Alice, if you could just say a quick hello to our viewers.
Hi, very pleased to be here. Thanks, Jason.
All right, and next up we have Jingjing, Vice President at PIMCO as well. She sits in the Hong Kong office, and she has an MBA from Columbia Business School. Jingjing, would you like to say a few words to our viewers?
Hey, good afternoon. Thanks for your time and interest today.
All right, thanks a lot, Jingjing. And of course, from Syfe's side, we have Ritesh, Vice President and Head of Investment and Advisory team as well. Ritesh, if I can just invite you to say hi as well.
Hey, hi everyone. Very excited to be doing this session today.
All right, great. So today is very exciting, and the reason being so is that our two guests, the time is very precious, so we actually have a hard stop at 6, right? We'll try and cover to the fullest extent, right? So without further ado, right, I'm just going to end the poll questions over here. We'll go through the answers in a quick while, all right? But yes, a little bit about Syfe. So Syfe, for those of the viewers who are joining us here for the first time, Syfe is actually headquartered here in Singapore. We have an MAS license, right? And we are actually a digital wealth advisory company itself, right? We do have two main platforms, one of which is the Syfe Wealth, where we actually introduce curated portfolios for clients to actually handle their wealth. Right. The other platform that we actually have for our clients is actually the Syfe Trade, which is a DIY brokerage of sorts, where clients can actually invest in single securities. The 4 clients over here that you see on the screen, they are actually actual Syfe clients. So they are a testimony to our mission here at Syfe, which is to empower our clients to manage their wealth for a better future. Right. And I think this is something that all of us here at Syfe hold very dear to our hearts. A quick journey of our, a quick snapshot of our journey year to date. Right, so we started in 2019, and since then, I would say we have had pretty major milestones in a very short period of time. Of course, the latest one that we had was also with PIMCO, was the launch of our Income Plus portfolio. Alice, I think she was there, right, in person, right, and it was back in April 2023 only. Okay, so obviously your funds at Syfe are kept very safe. I won't go too much into the details over here, but just take note that clients' funds and Syfe's operational funds are always kept segregated, be it cash or be it invested assets. All right, so if you'd like to find out more, of course, feel free to schedule a call with anyone from the advisory team. Right, we'll be able to actually go into much more details. Okay. All right, so the moment that I think most of us, or rather some of us, have been waiting for is the poll results. Okay, so you should be seeing the results on your screen right now, right? Just a brief recap. First question, where do you think the Fed rate will be in a year, right? Given the context here where the Federal Reserve actually increased their policy for to a range of 5.25 to 5.5 during July itself, right? So 46% actually mentioned higher, right? This is a year later, pretty interesting, right? And then the remaining 26% unchanged and 28% lower. Wow, pretty interesting. Second one, looking ahead to the next 6 months, which asset classes are you looking to allocate more? And wow, majority of us actually said bonds and equities. All right, no surprises. Lowest was actually crypto, a little bit surprising for myself, right? And the last question, have you invested into the Income Plus portfolio? I think this is the more interesting one. So pretty much well spread out, I would say. May I invite our speakers to have a quick thoughts about this? Ritesh, perhaps you want to go first?
Yeah, I think very interesting results. The first one is actually very, very surprising. We have a view that the rates are peaking, and perhaps like PIMCO will cover these aspects as well. But it's interesting to see a lot of our clients believe that there are more rate hikes to come. So I believe much more hawkish than what Fed is right now, I would say. The second one, I think, is also a good positive surprise to me, because typically our user base are more equity oriented. So it is good to see a lot of interest in the bond side. And the third, I think, is again very interesting, because it goes to show that a lot of the folks joining in today have already invested into Syfe Income Plus, but there are also a lot who are definitely interested. And a lot of people, I mean, like the third bucket, which is like not sure yet, hopefully you will get a much better perspective about fixed income and Income Plus after the session.
Yep, definitely. And perhaps a few words from Jingjing as well before I hand it to you.
Sure, I'm just looking at the answers to the second question. I think I may not be needed for the session, because I'm going to talk about how you should diversify your portfolio, and your answers is already showing pretty much a good diversification. But hopefully my session is going to help you understand more in terms of how diversification is going to help your asset allocation in a broader portfolio.
All right. So looking forward. So, okay, I think without further ado, let me just hand over the time to Jingjing, who actually gave us a quick market recap. Jingjing, please.
Sure, thank you. So yeah, let me first have a quick review and show you what happened in the market, since you probably participated in the portfolio, and also help you to understand what you have experienced over the last few months. So if you can move to the next page, this pretty much sums up in terms of interest rate movement as well as the credit spread movement. So quarter to date, that's probably what concerns you the most, given your portfolio with the Syfe Income Plus was launched in April, and you could see that basically the yield curve has moved higher in the US. And right now we are at a point where the 10 years is, as of yesterday, is around 4%. So people are wondering how this is going to change the portfolio, and also where we think the yields are going to move further to. Overall, we think that the current level is closer to our expected range, actually the high end of our expected range. And we think right now it makes sense to add some duration in the portfolio given that movement so far. And if you look at the credit spread movement over the past months, the spread level has tightened across the IG and high yield sector. But you could also see that higher beta market sectors recovered faster than the high quality names. That is also an interesting dynamic that has been moving part of the market and the performance of your portfolio. And similarly, the equities market rebounded pretty strongly with the S&P 500 returning close to double digit for months to date, and quarter to date you register a over 8%. And we think this is also a rebound that's recovering much of the loss that was incurred last year. Because if you remember what happened in 2022, the equities market was down 20 to 30% and sometimes even more in the more higher octane market segments. So overall, we think the market has shown us a very high volatility period of time. And this is also quite consistent with our overall outlook for the upcoming year. So if you look at the next page, for those who understands PIMCO's investment process, we have this forum tradition where all of the investment professionals gather together on a quarterly basis and annual basis to talk about the short-term and long-term investment themes and the secular and cyclical outlook. So in our latest forum, we think that the economic outlook can be concluded as a theme of an aftershock economy. What does that mean? For those who are familiar with earthquakes, you probably understand after a big shock or a big earthquake, the smaller waves of aftershocks are going to come. And we think in the next 3 to 5 years, we're going to be under these aftershocks, and we are going to experience a heightened level of volatilities. And that means 4 themes for our investment implications. So first of all, in terms of the macro growth, we do think that it will be a slower growth picture for the global economy, especially the developed markets. And we also think that there is still the risk of a recession hitting major developed markets. Although we think the probability has decreased over the last several weeks in terms of how likely a recession will happen, or how deep a recession will be, because as you could probably tell from the macro data that's been delivered in the US, you could see that the labor market is actually tighter than what people originally expected. And the economy has shown slightly higher level of resiliency than what people would think, and also what the Fed has thought about. But in general, we do think that the tighter conditions in terms of the credit growth, that's still going to be a big constraint for economic expansion. And we also think that there is very limited in terms of what the monetary policy and fiscal policy can do to stimulate the economy. That's why in the second theme, we think that there will be less intervention and the market volatility will be higher than before. And we're also seeing countries and companies facing more supply constraints, and they are also willing to pay more to build up that resilience. For example, the countries are willing to build on more reliable trade relationship, and the companies are also willing to spend more and invest in a more reliable supply chain. And that's going to cause a higher cost for the companies, for the global economy. But at the same time, it's going to help the economy gradually build up higher level of resiliency. So what does that mean to investors? We think under this market environment, it's going to be very important to focus on three things. One is resiliency, as we have talked about, and 2 is focused on liquidity, and 3 is having a diversification in the broader portfolio. So resiliency we have explained, and liquidity is also easier to understand. Basically, we wanted to make sure every assets that we have included in our portfolio is liquid enough. And what about diversification? One thing that that's not easy to help retail investors to understand is how can investors improve the overall portfolio by maintaining a diversification. And if you look at the next page, we think basically keeping a diversification is almost a free lunch. So here you can see how adding a combination of a stocks portfolio and a bonds portfolio is going to help you reduce the volatility and improve your overall risk-adjusted return. And think about how bonds can function in a broader portfolio. The rates movement, they generally move in the opposite direction with credit spreads. That means when your credit spread widens, your duration exposure is going to give you that buffer. And then at the same time, in general, the bonds would historically move in a opposite direction with equities. That's the historical negative correlation of the two asset classes. So these different forces and the different directions of movement, that's going to help you improve the efficient frontier. It might sound too technical to you, but to easily understand it, it's basically taking each unit of a risk, whether someone can achieve a higher return. That's basically what diversification can help you and improve the overall portfolio. And this is why we think it's very important to keep the core bonds as a structural exposure in a broader portfolio. It can help you with capital preservation. It can improve your total return. And also it's a very effective diversification to your existing exposure to equities market. And we think it's especially important to have that bond exposure when the market valuation is priced at attractive level. You probably saw how the rates has moved up, and also how the year of 2022 have moved the valuation of the overall bond market to a very attractive level. But does it mean we need to buy everything when it's cheap? On the contrary, we think we should actually be more selective. So in the next few minutes, I'm going to quickly share with you where we are seeing more opportunities and where we are seeing the risks. If you look at the next page, this is how we would classify different sub-asset classes within the fixed income market. And as you can tell from the dial, we are very differentiated in terms of how we allocate across these different sectors. And let's start with the first one, investment grade. Look at the next page, you will see that investment grade right now, their valuation is priced wider than the pre-COVID heights. And at the same time, it's also very important to note that behind this average valuation level, the differentiation is very important. And we are seeing this divergence across different sectors and industries. And we are seeing a higher level of valuation, or more attractive valuation in the more COVID recovery related sectors, and the tighter valuation in the more resilient sectors. So we wanted to focus on what sectors are going to give you more upside potential by focus a lot on the bottom up selection, credit selection, and company selection. And if you look at the credit migration in the next page, You would also see that right now, there are more names that's getting upgraded than downgraded. So the green bars are showing you what names in what year are getting upgraded. And a very clear trend is we are seeing more rising stars than falling angels. And that's a reflection of how the improvement of the fundamentals is being reflected by the third-party rating agencies. And we think that's very important because as an investor, PIMCO is very active in preempting those credit rating migration in terms of capturing more rising star opportunities and avoiding the potential falling angels before they get reflected by the rating agencies' credit ratings. So next, if you look at the high yield market, it's also a very important and interesting market. On the next page, you will see that we have a relatively differentiated view, and we think the high yield market, it's very important to see which part of the market you are in. And if you look at how the market has expanded over time, you will see that most of the expansion came from the leveraged loans sector. These are the bonds that's paying floating rates. And we think these will be the more risky parts, and we wanted to be more cautious because the expansion came from the single B or even riskier part of the market. Whereas the high yield bonds that pays a fixed rate coupon, these are more resilient and their fundamentals are more solid. So in high yield, we wanted to focus on the up in quality, the double B, and also the traditional fixed coupon paying bonds, whereas we wanted to avoid the bank loans and the leverage loans that has been expanding, and it's going to face a lot of pressure in a high interest rate environment. And we think that's the default risk we wanted to help our investors to avoid. So last but not least, I also wanted to touch quickly on the next page, which is our view on the Asia market. So we think right now it's also a very important and interesting timing to look at Asia. As we mentioned in the earlier page, where we are forecasting a recessionary environment for the global developed market. But we think Asia is going to stand out in the sense that here, as you can see, the GDP forecast for the Asia region is going to outpace that of the developed markets, led by the growth from India, Indonesia, China. And at the same time, we think the companies in the region are facing less of an inflation pressure compared to the companies in the developed markets. So we do think if you stay selective in this region, it will present you with higher selective pockets of opportunities. And we also understand some people are trying to capture the Asia opportunities by going into different asset classes, for example, the stocks market. And on the next page, we also help you to run a historical analysis to understand what makes more sense to move up the efficient frontier or to maximize your risk-adjusted return. And here you can see that in terms of the valuation, Asia compared to developed markets, it gives you that premium. And at the same time, historically, our numbers also show that the Sharpe ratio you can achieve from the Asian bond market is actually more attractive than what you would get from the stocks market. And if you look at the spread level, we are also seeing a pretty decent pickup from Asia IG and also Asia high yield compared to their developed market peers in US and Europe. So overall, we wanted to summarize our investment outlook and view as right now, we do think that there will be heightened level of uncertainty and volatility. So it's very important to be selective, to focus on liquidity and quality, and also to be very diversified as how you allocate your broader portfolio. Let me pause here and give the time back to Jason.
All right, thanks a lot, Jingjing. Next, we'll have Ritesh, who actually give us a performance review of the Income Plus portfolio up to date. Ritesh, please.
Sure. Hi, everyone. Thanks, Jingjing, for covering the market outlook. One thing is clear, there is definitely compelling opportunities on the fixed income side, and not just on a global basis, but also on the Asia front. I think, as you covered earlier as well, there is opportunities, whether it is on capital preservation side in terms of income, but also from an equity diversification standpoint and all, right? So all of those, I think, make it very, very compelling in terms of looking at fixed income right now. Now, I guess to kickstart this part of the section, we have launched Income Plus 4 months back, sorry. So it was April when we launched the Income Plus offering. And first of all, I would like to convey my big thanks to all our clients who have shown overwhelming support and invested into this portfolio. Now, as you know, Income Plus is a first of its kind fixed income offering where we have partnered with PIMCO, who is a global leader in active fixed income, and to generate the best outcomes for all your income needs. This is the first time that PIMCO, with over 5 decades of experience in fixed income investing, has partnered with us, Syfe, as we lead the digital investment space and with the trust of over 100,000 Singaporean investors. Now, this partnership, what does it do? If you move over to the next slide, it really allows Syfe to not only use the best-in-class active funds from PIMCO's fixed income product suite, but also use their forward-looking market views and time-tested investment process to construct these portfolios and optimize your income needs in any market condition. Now, there are 3 key aspects in terms of our investment process. The first one is a forward-looking investment view. Now, as you will know, in terms of how fixed income instruments behave, typically as interest rates move up, the fixed income performance turns negative. And it's at that point that most of the investors kind of give up. And this is exactly what has happened over the last 1 year, right? Fixed income, the returns have been more subdued because there have been a continuous interest rate hike. And even this year, when we are reaching close to the peak in interest rate, you've had some volatility because there was debt ceiling related volatility, as well as the recent rate hike in July. Now, you can look at it as a risk, but at the same time, you can also see it as an opportunity, because once the interest rates are moved up and the valuations of fixed income become depressed, that actually also presents you a lot of potential future opportunities in which you can capture them and improve your returns. And this is where our process, which is basically informed by PIMCO's forward-looking views on the market, constantly seeks to position the portfolios to capture the best opportunities in terms of future return potential. Secondly, there is a broad opportunity set. So here, as you know, we are using PIMCO's active funds in terms of the building blocks, and that gives us a lot of ways to capture a lot more alpha potential and to manage risks much more prudently, compared to the more passive side of the world, where I think, especially on the fixed income side, it becomes a little bit more tougher for passive instruments to do justice for income-seeking investors. And lastly, I think on the analytics side, it is also a very precision-oriented game when it comes to investing into fixed income. And given that PIMCO has a complete look-through in terms of their individual funds that are used as part of these portfolios, it allows us to have a much more detailed risk management process as well, and navigate through uncertain market environments too. Now, moving on to the next slide, let's cover quickly a recap of the 2 offerings that we have. So the first one is Income Plus Preserve. So here the yield to maturity of this is 6.7%, and it also gives a monthly dividend payout of between 4 to 4.5%. Now, yield to maturity typically depicts the return that you can expect from this portfolio if all the underlying bonds held within the portfolio are held to maturity. In terms of how to think about it, there is the portfolio characteristics. So 4.9 in terms of duration, that gives you a sense of where the average maturity of the portfolio's bonds are, underlying bonds are. The credit quality kind of tells you how safe the instruments that we are investing into, and beta kind of tells you, how the riskiness of the overall portfolio is. Typically, the 0.1 beta basically means that if the equity market moves by 1 point, the portfolio, which is income plus preserve, will move by 0.1 point, right? So, 10% of the movement that you expect in the equity side. So much, lower risk compared to the broader equity market. But in terms of, if you look at it from a return perspective, the returns are, highly attractive in the current environment. In terms of exposure, you can see that on the preserve portfolio, it is mostly dominated by the more investment grade universe. So if you're looking at more consistent returns, less volatility, then and also more of a preservation mode, then I think this portfolio can do justice to you, because it is primarily invested into investment grade, securitized, and the government related securities. Similarly, on the country side as well, it is much more invested into the more developed side of the world. On the other hand, if you move on to the income plus enhanced portfolio, here the yield to maturity is even more attractive at 8.4%. The monthly payouts range between 5 to 6%. The duration is actually a bit lower. There is slightly lowered credit quality, but still, at A-, which is considered, much higher up in the value chain. And the beta slightly gets higher at 0.2 as well. In terms of the exposure, this portfolio has a good mix of the more investment grade aspects, but it also enhances your yield by taking exposure to the credit components of fixed income through the high yield and emerging market allocations. You move on to the next slide. I think, this is another key aspect of the portfolio. We use the institutional share class of PIMCO funds, which means that the cost of investing into these funds is a fraction of what you would pay typically if you were to access these same funds through a retail platform. And even if we, use the retail funds in some cases, we actually pass on 100% of the trailer fees that we receive from PIMCO to you as an investor. And on top of that, there are no sales charges. So that really translates into pretty hefty, savings when it comes to investing into these portfolios. If you move on to the next slide. Now, I think, the portfolios have been live for over 4 months now. And, I'm happy to share that both the income plus portfolios have outperformed the broader bond market since inception. So the portfolios were incepted 31st of March 2023. It's 0.3% on the income plus preserve and negative 0.1% on the enhanced compared to the index, which is at 0.3% negative. Now, of course, the last 3 months have been dominated by a lot of volatility in the market around the debt ceiling, brinkmanship, as well as, the recent rate hike. But given where, again, the rates are right now, you are seeing that the payout yields are very attractive at 4.2 and 5.6% at the most recent print from these two portfolios. And we continue to see, a lot of interest because, as we move towards the peak in interest rate, we are looking at much higher yield and total returns from these portfolios too. If you go on to the next slide, it actually also captures why it pays to invest into this portfolio versus investing into a single fund per se, right? You can see that when you invest into one single fund, the monthly returns can be very volatile, right? And especially if you look at the Asia side, where potentially there are much better opportunities as we move forward. But if you only invested into that one fund, you will go through a lot of up and down. But if you were invested into our preserve portfolio and enhanced portfolio, that's where the diversification comes into play, because we are meticulously thinking about how to combine all of these different fixed income sectors in a manner to maximize your income and total return. And that's why both these portfolios show much lower volatility and have both done very well against the reference indices as well. If you look on to the next slide, quickly recapping also the payouts from these two portfolios. So we had a payout range for these two portfolios on the preserve 4 to 4.5%, and on the enhanced it is 5 to 6%. And again, happy to report that both the portfolios have achieved their target payouts, and roughly in the middle is what you see. If you invested $100,000, you're looking at over the last 3 months generating close to $1,000 and $1,400 from these portfolios, translating into an annualized yield of 4.2% and 5.6%. If If you go on to the next slide, and this again proves the attractiveness of investing into a diversified portfolio such as this. Now, of course, in the current environment, you are getting decent yields even when you invest into fixed deposits, Singapore saving bonds, and even our cash plus portfolio. But again, these will not still beat inflation. Inflation is still north of like say 4%. So these are still below inflation from that perspective. Now, just the monthly payouts from these portfolios are actually covering you from an inflation perspective. But if you look at it from a much longer time standpoint and over the next few years, the yield to maturity can give you a little bit of a sense that if interest rates are at a peak and potentially the rate cuts will happen sometime next year, then from a total return perspective, the yield to maturity of these portfolios also look very, very attractive. With that, I think, conscious of time, I will hand it over to Alice to cover the next section on why fixed income now.
All right, thank you, Ritesh. Very happy to share a bit of taking a step back to talk about more broadly why investors should consider having an allocation to bonds, fixed income, within their portfolio. So if you can turn to the next slide. I think my colleague Jingjing mentioned a very good point earlier, which is that diversification is probably the only near free lunch in investing in financial markets. And over here, you can see that what we've done is we've shown the returns of different asset classes and color coded them. And the idea is not for you to try and track each color and see which one has done best, right? But the idea is that you can see this chart is very colorful, where there isn't a very clear trend in terms of any particular asset class that will do well every single year. I think just now Jingjing also mentioned the 60-40 portfolio. So 60% equities, 40% fixed income. So that provides a good balance between stocks and bonds, and that is the white color box. So you can see that over time, there are periods, there are years where certain asset classes do better and others don't, and there will be years of reversal as well. But having a more diversified portfolio across both equities and bonds, in the white portion, you can see that most years is actually in the top half of the box. So that means that by staying diversified, you are actually having a pretty good experience on a year-on-year basis. And some of your clients, some of you may think that, equities generally still have a higher return over time. So why don't we just put in equities, especially if you are younger, you have a longer time horizon, why don't I just put into the stock markets, don't look at it, and that should give me a better return over time. And it is true that equities can provide higher returns over time, but again, the level of diversification is important. And at the same time, also the entry point matters. So to give you a sense, right? But if you enter the market at the wrong time, it can actually be quite detrimental to your overall returns. It will set you back pretty much because, for example, if you start off with a portfolio of $100, and let's say you went in in a bad year, and the moment you go in, you get a 50% drawdown in your equity markets, which that has happened before. In the 2008 global financial crisis, equities actually were down close to 50%. So it can happen. So let's say from $100, you have 50% drawdown, you are back to 50%. And even if, let's say, the year after that, equities also deliver back 50%, you're starting off with $50. And if you make a 50% return on your $50, that will bring you to 75. So that means that actually to make back to break even to a $100 portfolio, you will need multiple years of much higher returns just to break even if you enter at a high point. So entry point matters a lot. And if you look at the next slide, we do think that equities right now look fairly expensive. I mean, if you look at the sorry, if you can just go back one slide, go back to the earlier slide. You look at the pink portion, which is US equities. No doubt US equities have done well this year. They are actually top of the table. But last year, you can see that equities have done pretty poorly. They were at the bottom, right? And given that equities have run up quite a fair bit year to date, so if you look again, go back to the next slide, we do think that a lot of equities look pretty expensive right now. Of course, we do see that if some of you may think, oh, you know, if only I had invested in equities this year, I would have done much better. Equities are up about 17% year to date, but a lot of that has been driven by what we call the Magnificent Seven. So these would be especially some of the tech names, and after the run-up, a lot of these tech names actually look pretty expensive. The rest of the market have also done fairly well, but overall, we do find that equities market right now are tracking quite expensive from a valuation standpoint. So price to earnings is actually pretty high, and not factoring in some of the growth concerns that my colleague Jingjing actually shared earlier. And if you go to the next slide as well, so we think that right now, comparing your bonds versus equities, actually bonds offer very good value. So if you think about it from just a yield standpoint, on the left-hand side, you're seeing the level of yields you're getting in the fixed income markets. And here you see a different bars. So you have the lighter shaded bar as well as the darker solid bars. And you can see that the lighter bars actually reference the level of yields you're getting at the beginning of last year. So 1.5 years ago. You can see that within bond markets, yields have actually come up to very attractive levels. So for example, in blue, you have your high quality bonds like US Treasury, so US government bonds, core bonds, which again are your high quality bonds, agency mortgages, which are also government guarantee assets. So these are actually very high quality instruments. You can view them as close to next to no default risk, and they are actually giving you yields of around 4.5% to 5%. So this is actually looking very attractive. And when you compare that to the dividend yield you're getting in the stock markets right now, that's on the right hand side of this slide in the gray bar, you can see that the yields you're getting in bond markets right now are actually quite comparable to the kind of yields you're getting in stock markets. So and if you look at the next slide, why we look at the yield is that's also a very important indicator of the forward-looking returns in the bond markets. So over here on this slide, the blue line shows you the yield you're getting, and here we reference the US high quality core bonds as a reference. So the blue line represents the yield, and the green line represents the returns you're getting in the bond markets 5 years out from that point. So you can see that the returns you're getting in the bond markets track very closely to the actual yield that you're getting. So for example, if you had invested in so let's just call it back in 1982, right? When the bonds peaked at bond yields peaked at more than 15%, and you invested in the bond market at that point in time, you're actually getting 20% returns in the 5 years following that. And then you can see that green line and the blue line track very closely together. So that means that there is a very high correlation, in fact, 94% correlation between the bond yields and the expected returns in bond markets. And if you look at on the right-hand side now, I just now showed you where the current yield of high quality core bonds is actually close to 5%. So this also gives you an indication where right there, since the global financial crisis, yields in fixed income markets have been at very low levels, and it is the first time in over a decade where bond yields are right now back to around mid-single digit levels. And so right now we do think that it is a very good opportunity for higher returns, to reap higher returns in the bond markets, given the higher starting yield levels. So right now, by investing in fixed income, not only are you getting that diversification benefit from equities, you are also getting much higher expected returns on a standalone basis from the fixed income markets. Now, then the question is, the next question is probably, is this the right time to enter the bond markets? Maybe just now the poll, the question, a lot of you say that, you know, the Fed funds rate may be higher a year on out from at this point. So does this mean that we should wait and enter at a later point? Is this the right time to be investing in bond markets? So if you go to the next slide. So our view at PIMCO is that, of course, we do understand that the Fed is very data dependent. So it really depends on the data that is being that's coming out on the macro data, on the inflation front, on the jobs market in the US, to determine whether the Fed will continue hiking rates or not. However, our view is that more likely than not, the Fed will either pause or hike maybe one more time by the end of this year. But we are pretty close to the end. So at the very least, we are also seeing signs that inflation is coming down. Inflation is moderating. The jobs market in the US still continues to be relatively healthy. So we don't actually see probably the need for the Fed to hike rates very aggressively from here on out. And at the same time, also, we are not expecting the Fed to also cut rates immediately, given that whilst inflation is moderating, we also don't see that the inflation is coming down so quickly that it is back down to the target levels of 2 to 2.5%. So it's still going to, we think interest rates are going to remain at around current levels for the next, couple of quarters. So in our most likely scenario, that would be on the right-hand side, where the Fed pauses and keeps the Fed funds rate at around these current levels for the next maybe 6-9 months or so. And you can see that historically, when we look at how stocks and bonds have performed, have delivered in terms of returns in an environment where the Fed pauses, but stocks actually return flat. So top right quadrant, you will see that historically, when the Fed pauses and keeps rates at a constant level for 6 to 9 months, stocks actually return kind of a flattish kind of return, whereas bonds will continue to deliver positive returns. And that's because given that the Fed has actually hiked rates, as I've mentioned, yields are on the higher side, and higher yields means higher returns in bond markets. Even if the Fed starts cutting rates, which again from the poll doesn't seem like people, at least on this call, think that the Fed will start cutting rates. More likely, the Fed may, the interest rates may even be higher. But if the Fed actually starts to cut rates, both stocks and bonds will actually deliver positive returns. So in either scenario, whether the Fed pauses or cuts rates, bonds will deliver a positive return. And then how about if the Fed really continues to hike interest rates? We also think that the outlook for bonds is actually still okay. If you look at the next slide, so over here, when we compare how the bonds fare versus cash, right? So you can see on this slide over here, there is a gray shaded portion on this chart. And this is actually showing you historically the period of time where the Fed has been hiking rates, for the central banks hiking rates. Typically, if you look at historical data, the average time, the average hiking cycle, so how long does the Fed or other central banks take to go from the bottom and the peak in terms of the Fed funds rate is on average 19 months. So typically the Fed will hike rates over a period of 19 months. We are now, the Fed first hiked rates in March last year. So we are actually now about 16 months into the rate hike cycle. So there is actually factoring in that, you know, there could be another 1 or 2 more rate hikes in the next couple of months. And you can see that when you look at how bonds actually deliver and how bonds fare and perform versus cash. Right. So in this chart, green shows you that bonds outperform cash, and red means that cash outperforms bonds. And no surprise that when the Fed is at the beginning, when they first start to hike rates, cash outperforms, because as interest rates go up, bond prices will fall. And of course, cash rates are going up as well. So you're getting more by staying in cash. But you can see that towards the end of the rate hike cycle, right, even if the Fed continues to hike rates a few more times towards the end, bonds will continue to outperform cash, because as I've mentioned, again, I need to reiterate that the starting yields is a very good indicator of the forward-looking returns. So when yields are at higher levels now, even if the Fed hikes rates a couple more times, the higher yields provide a buffer for further interest rate increases, and also delivers more return compared to cash. So when you look at high quality bonds now, core bonds are giving you close to 5% yield, whereas if you look at what cash is giving you now is between, depending on what kind of cash rates you're looking at, between 2.5% to at the most 4%. So bonds have a significant yield advantage over cash right now. And at the same time also, we also see that cash comes with an opportunity cost, because at some point in time, if the Fed starts to cut rates further out, sometime next year, for example, you are going to, if you hold in cash, then your cash rate will start to go down. And you're not able to reinvest your cash at that higher yields. Whereas if you are investing in bonds, you're locking in the higher yields. And if rates come down a couple of quarters down the line, bond prices will also increase as yields come back down. So then you're actually getting potential capital gains in bonds as well. So overall, we think that bonds also offer a very attractive proposition versus cash, given that we are again towards the end of the rate hike cycle now. Most of the volatility that we've seen in bond markets have already materialized, and the outlook for the returns in bonds looks a lot more attractive at this stage. So recap, bonds right now look attractive versus cash, clearly, even versus equities, given the higher yield environment now, and also as a diversification tool to lower the overall volatility and improve the overall risk-adjusted returns in investors' portfolios. So with that, I'll hand it back to Jason for any questions.
All right, thanks, Alice, and thanks to Ritesh and Jingjing as well for the quick sharing. Now we'll head over to the Q&A section, and I think first up is actually a question that one of our participants actually raised pretty early, in fact, at the start of the webinar. So I think I'll address this to Alice or Jingjing. And the question here is this: with regards to a bond portfolio itself, what are the implications considering inflation, interest rates, and of course the time period is in the next year also, so probably around 12 to 18 months, right? And it would be great if you can give us a bit of a perception as well as what are your thoughts about this. Perhaps Alice, you'd like to go first?
Sure. I think I kind of alluded to that in my last slide just now, where
Yes.
our expectation is that in our base case, we think the most likely scenario is that the Fed may pause or may hike one more time, But clearly, we do think that we are very close to the end of the rate hike cycle. So we are not expecting interest rates to go up much higher from this point. And also for rates to stay at current levels for quite a while, and potentially the Fed to only start cutting rates further out into 2024, given that inflation continues to remain quite sticky and not even though they're trending down, are not back down to the Fed's target levels yet. So overall implications for fixed income, given this base case scenario, is that we do expect that the opportunity in fixed income to be quite attractive. We are expecting higher returns by investing in bond markets, and overall less volatility as compared to the last 18 months.
Okay. Ritesh, any further comments on that?
Yeah, no, I think Alice covered it really well. But for me, I guess just to add on, there are just three scenarios that can happen, right? Either interest rate goes up, it remains flat, or it goes down. Now, in terms of it going up, and this is what Jay was asking, what if it surprises to the upside? My view is that look, there could be maybe one more rate hike, but it is highly unlikely that it'll go 2-3% up from here. Because the Federal Reserve will also have to have a very good balance in terms of increasing interest rate and producing stress in the market, right? So it has to balance that out. And what that means is, and inflation, which is one of the key drivers of why interest rates are moving up, is clearly on a downward trajectory now, and both the headline and now also on the core inflation side. So for me, the upside potential in terms of interest rate is very limited, which means that, even if the bond prices come down, you have the buffer, as Alice shared, in terms of the higher yield point that you're starting with. So that'll, provide a lot of cushion. The second scenario is if it remains flat, then, of course, you're capturing that high yield, so good to invest and start now. And if the interest rate goes down, then I think it's great, because then, you're capturing the high yield, plus there is, upside potential. So, generally speaking, this is an environment where, on the balance, the, opportunity is much more positive on fixed income in general.
Right. Thanks, Ritesh. I think we have one more time for one more question from Alice and Jingjing's side. So perhaps Jingjing, you could pick this up. And the question here is, does the portfolio have a monthly redemption limit? So I think the viewer is also curious with regards to the liquidity risk itself. Jingjing, please.
I think I should defer this question to my colleague Alice.
Sure,
Sure,
yeah.
sure.
Yeah,
Alice,
let me
please.
take that question.
Mm.
Yeah, so the Syfe Income Plus portfolios actually invest into PIMCO's daily liquid mutual funds, and all of our funds are able to meet redemption requests on a daily basis, right? And at PIMCO we manage liquidity very carefully, and we ensure that we are able to meet all redemption requests daily. As a data point, even during the 2008 financial crisis, at the peak of the crisis, when liquidity in the market was pretty challenged, we have not had any issues in meeting daily redemption requests. So I hope that gives some comfort to the person that asked this question.
All right, thanks, Alice. And Jingjing, if I can just squeeze in a last 30-second question here. And the question here is, with credit spreads so tight, does it still make sense to invest in bonds, especially based on our outlook of growth disappointment, volatility, and recession risk? So this is quote for quote. Jingjing, please.
Sure, thanks for asking this question. So first of all, credit spreads, are they very tight? If we look at the historical percentile, where if you rank the current valuation in the 20 years history, you will see right now it's around the average of the history. So we don't think it's too tight. It's actually relatively fair fairly priced compared to the historical levels. And if you're talking about the high quality bonds, let me decompose what you will get from a IG bond. So typically right now, the benchmark is yielding 5.6%, and your credit spread is about 120 basis point. And the other 4 to 5% is actually coming from your interest rate exposure. So your duration exposure is going to drive a lot of those returns. And starting from a 5.6% on average for an IG bond, you're actually in a very, very good position, even if a recession hits and some widening in the credit spread happens, you are more than enough in terms of that cushioning by this high level of all-in yield. And this is also why year to date, we have seen a strong inflow coming into the investment grade, the high quality part of the bond market, where we have seen 140 billion US dollar of net inflow coming into the high quality market because of the attractive all-in yield level that can cushion for your widening, even if a downside scenario happens.
All right, thanks, Jingjing. And I know it's 6:01. Jingjing and Alice, unfortunately, they have to head off for another appointment, and they actually really tried to squeeze out as much time as possible for us. So thank you, guys. Thank you to the both of you. Perhaps any last comments before I let the both of you go?
No, I just think thank you very much for attending today, and thank you for your interest in fixed income and the Syfe Income Plus portfolios.
Thanks, Alice and Jingjing.
Thank you very much.
All right.
Thank you.
So thanks, Jingjing and Alice. You may log off right now. Ritesh will still continue to remain
Thank
here
you.
to answer a couple more questions. We actually have quite a few this evening.
Yeah.
So
Jason, maybe I can, like just pick up on a couple of questions. I guess we can start off with one of the questions, which is again Jay asking us on the interest rates if they are cut and if they drop to 2019 levels. Are these portfolios short term, or what will happen to them and all? So I guess number one, typically the bonds that are invested into the portfolio, they're invested with a decent duration in mind, right? So you saw that the duration was between 4 to 5 years. So when you invest into these bonds right now, you do lock in kind of the yields that are present in those bonds. And if there is rate cuts, potentially the effect of those rate cuts will stagger over time. And the good news is, alongside the higher yields that you're capturing, you will also capture the price appreciation from them. I guess let's also take a look at there was this one question. I think a lot of questions, a lot of people have previously asked us in terms of where the income is generated from in our income plus portfolios, and is it something that gets taken out of capital? Now, this is a very important question because when you invest into any particular instrument, if the returns that you're generating, if it is primarily coming out from the capital itself, then over time the capital will erode. So on our side, when we are constructing these income plus portfolios, the bond funds that we are using, the overall objective of these bond funds is to maximize total return and not just generate regular income. So alongside the fact that they need to generate regular income, they also seek to maximize total return. And that's why the payouts that are given from these funds are primarily from the bond coupons of the underlying portfolios rather than from the capital, right? So the capital usage is very, very limited in terms of the sources of the monthly dividend yields that are coming to you. One more thing to note is the number of units of the individual funds that we have on our platform or the portfolio that you invest into, they do not decrease even if there is a payout, which basically means that you're still invested into the same number of units. It's just that the portfolio has bonds which have given coupons, and those coupons are then kind of getting passed on to you as an investor. So that's, I think, one of the aspects. And again, I think just from a perspective of where interest rates are, potentially clients can look forward to two sources of return. One is from the monthly payouts from these individual funds and the portfolios. So preserve 4 to 4.5% and enhance, you're looking at that 5 to 6%. And if the interest rates are cut next year, potentially sometime, then you're looking at some sort of capital appreciation, and which is what is getting captured from the YTM standpoint, the yield to maturity of these two portfolios, which stand at 6.7 and 8.4%. And that again, gives you that perspective that why do we call this particular session equity-like return from bonds? Because typically bonds are supposed to give very low returns and they're supposed to be safer as well. But right now you're getting these higher yields from bonds, and you're taking maybe half the risk of equity, right? So this is where potentially the fixed income market looks very attractive from a risk reward standpoint as well. I guess we'll have to stop now, but if we have been unable to take some of the questions from you guys, please just feel free to reach out to us on the advisory team. If you're an existing client on your app, there is a very easy way for you to connect with us and schedule a call with us. If you're not yet a client, there is on our page, on our website, there is a way to schedule a call with our wealth advisory team as well. And feel free to write to us. We are again available for you to seek any opinions and something which is a little bit more specific to you.
Yes, Ritesh. And I think to maybe conclude today's evening's session, yes, there are also a couple of questions from existing Syfe clients and obviously potential clients as well. And these are a bit more specific to your individual investing approaches. So questions like DCA, should you DCA or should you adopt a lump sum approach? If let's say you're in your early 20s, should you adopt income plus portfolio as part of your total allocation? So I think these questions itself, they are obviously best answered one-to-one, and definitely the advisors will be in a better position to actually address some of these questions itself. Right. So yeah, with that, I do thank everyone for their participation this evening. We will upload this session onto our social media channels, so do keep a lookout for them. If obviously you are not subscribed to Syfe, do subscribe, right? If not, Ritesh, any last words? If not, I'll say thank you and end the session.
Yeah, thank you everyone for joining in.
All right, thanks everyone. Have a great evening.